good afternoon, and thank you very much, everyone, for staying. I understand that this is the last session of today, and I've been told it's the graveyard session, so I'm so happy that so many of you have stayed. Now, China, I'm here to talk about China. I am based in London. I literally flew in this morning and I'm leaving this evening, but I wanted to be here today in particular to talk to you about China. As much as I heard today since this morning, China was mentioned in snippets. But in fact, I heard a lot of common grounds that both Africa and China are striving towards. And yet, when we talk about capital markets, financing, we often talk about tapping Western markets. We talked a little bit about local currency markets, and in fact, in London, I worked for a joint entity of ICBC, globally the largest bank by asset value, and Standard Bank. So based in London, what we do is we talk to institutional investors about Africa and other emerging markets. We are also starting to talk about China's domestic bond market. So today, what we wanted to do actually is to take you through a little bit about China, China's capital market, the growth of China's domestic market, and in particular, how potentially Africa could also be tapping into this domestic market, which is now the second largest bond market in the world, but yet still less than 3% accessed by foreign institutional investors. So hopefully you can see the slides in front of you here. So actually, just to set the scene, today I'm going to talk to you about 3 Ds. If you remember anything from my talk over the next few minutes, I would like you to really remember these 3 Ds. Number 1 is dual circulation. This is a theme that has been talked about by Chinese policymakers, so you'll probably hear about it a lot. It is about the simultaneous circulation between domestic Chinese capacity and the interaction with international participants and partners. So this first D is very important. We just had the most important meetings in China in March, called the Two Sessions meeting. And why was it important? This year marks the final year of the current 5-year plan, the 14th 5-year plan. So it is more pertinent, especially given the current geopolitical context, to ensure growth this year and to ensure that this final year of the 14th 5-year plan ends on a high. So in fact, what was very interesting was that we talk a lot about the two importance, or the 3 twos I call. Here you see some Chinese characters, but I just wanted to give you a flavor of what the government work report delivered. First of all, we have the 2 majors. We're talking about the major industries, strategically important industries and infrastructure projects, welfare projects. These are the key aspects of China's economy that comes from the domestic capacity. And the 2 news, new infrastructure, new urbanization, and finally, 2 industries. Now, I'll go on to talk about how much policy, as Sir Tony Blair talked about, it's not enough just to have a vision, but you have to have the policies in place. And certainly there is enough policies, and particularly ensuring implementation of policy, being committed to these 3 twos. And you'll hear on some of those important keynotes and highlights from the government work report in terms of just where China is in its own development and transition. We talked a little about technology. We talked about renewable energy. If you look on ChatGPT, you have some answers, great. Now look on DeepSeek. These are the things that will be driving what's going to be challenging the status quo. And I believe in thriving economies in Africa. Now, Africa and China together accounted for around 1/4 of global growth last year. Now, going forward, growth is going to be challenged, especially given tariffs, especially given the current geopolitical tension. So Let's secure that growth. So China is committing a lot of fiscal resource. So in the next slide, fiscal support is the key in this year's government work report. Here I outline some of the key targets. So to get to 5% GDP growth this year in China, we are seeing fiscal deficit up to 4% of GDP compared to 3% usually. We're seeing dedicated 1.3 trillion RMB worth of ultra-long special sovereign bonds, tapping into the China's bond market. So central government can finance quite cheaply in China. And now it's about mobilizing that liquidity and financing to really make sure that the capital is being channeled into where it's needed and most needed in the real economy. So to talk about growth and to mobilize the resources, enable and empower that growth is exactly what's happening in China. And I like to think that some of that will happen in the high growth economies. And in particular, this is what I see every time I visit Africa. I feel this revitalization, if you like to call it, but energy to reform and to change for future growth and development. Now, in China, one of the things that, for a population of 1.4 billion, roughly Africa will be getting there, given that Africa's population is youthful. Median age is 19 compared to China, 38. China's population is declining, but in Africa, population growth is still 2.5%. So eventually, Africa will also be thinking about the similar challenges, how to make growth not just numerically or quantitatively high, but also of higher quality. So the productivity of every single percentage of that GDP growth is exactly what the current policies in China is focused on. So all of those buzzwords in China, whether it's renewables, the new economy drivers, technology, what is happening here is that the realization of that 5% will not be forever. How do you achieve potential growth, but for what's available in the financial markets to be more productive, to be channeled towards where it's most needed? So that's a message I want to carry today. So I'm here really to talk about the 3 Ds. So I talked about dual circulation. Domestic capacity requires interaction with international partners. So trade diversification has been a tremendously important aspect of that. So facing tariffs, facing increasing uncertainties in global markets, what has been happening over the past decade, and actually accelerated by COVID, is the need to diversify not only trade partners, but also investment partners too. So China is not only attracting foreign direct investment, portfolio flows, but also it is also, investing abroad increasingly. So from a trade diversification point, diversification absolutely is vitally important. And why is China's domestic market, bond market, so important? It is now the second largest bond market in the world, but very, very little invested by foreigners. So essentially, very much like Japan, a lot of that debt is held domestically. But we are seeing more and more foreign institutional investors coming into the market and being interested. And really, for the past 8 years or so, we have seen particularly foreign sovereign institutional investors diversifying, and really the bond indices inclusion. So 3 major bond indices has included China. And what we have seen is really asset managers following those indices. Now, this is not to say that we're going to suddenly have an influx of foreign investors in the market. But what's happening here is that this market is becoming more and more dynamic. and more liquid. So across 24 hours, across time zones, we are seeing foreign institutional investors, we're seeing sovereign investors accessing this market through different time zones. Here in Africa, absolutely the same. Lots of institutional investors also interested in that market. So I'm saying that this is a large bond market, but still very much only really tapped by Chinese domestic issuers. Now, Panda. I had a quick look on ChatGPT and DeepSeek, and there's no pandas in Africa. And I hope one day we will bring pandas to Africa. But certainly, from a capital market perspective, there are already pandas being issued. So what do I mean by panda? A panda bond is a bond that's issued in China's domestic market, but by a foreign issuer. So as far as I know, there is now one African issuer. I'm not promising that obviously there will be lots more, because obviously there is still very much a regulatory approval process. And being very realistic, a lot of panda issuance have gone to high-rated issuers. But that's not to say in the future things could change. And in fact, what we've seen in recent years has been opening up of regulation to attract more and more issuers. And the reason to look into this is multiple. And I think number one is diversification. It really tapping into China's domestic investors. So of course, commercial banks, so for example, ICBC being one of the 4 largest banks, are one of the biggest investors and also underwriters in this market. And number 2, to build your profile, whether you're a corporate issuer, sovereign issuer, or institutional issuer, if you would like to engage China from a profile perspective, this is a great way for the market to know more about you as an issuer. So on top of your existing issuance programs, issuing denominated in renminbi, the local currency, is another great way to build your books really in a different market. And finally, there has been a lot of regulatory progress in terms of looking at the eventual use or source of that fund and also eventual use of that fund, whether you're able to expatriate it for use outside of China. To date, there has been lots of issuances, but majority of that issuance, the funding has been used domestically in China. So obviously the attraction will be, how do you access the low cost of funding in China? And actually pandas have varied below 3% to maybe 6%. So relatively speaking, still quite cheap funding in an international market perspective. However, depending on your sovereign rating, and usually there will be a domestic rating agency that will give you that rating. It really depends. So it's about the interaction with the regulators, whether it's PBOC, NAFMI, depending on whether you're corporate or financial institution or sovereign. And really, from a panda perspective, the theory is this: there is plenty of liquidity and plenty of capital in China's domestic bond market. How do we tap into that? And how do we ensure a whole host of investors are available, ready to understand more about the issuer and ready to open up to a further dialogue? So if you haven't already, I would absolutely encourage you to have a more in-depth conversation with either your Standard Bank representative, or we have ICBC representative office here in Africa, or even in London, we have offices as well. But the underwriting is done domestically in China. So it gives you another channel, another aspect to explore. And I know that China, in the current status of things, is that China's domestic market is growing. Now, China is often seen as the producer of many goods, but China is going up the value curve. So rather than just really producing global goods, China is increasingly becoming a global brand. If you look at the top most recognized brands globally, often it will be lots of US brand names, whether it's in technology, whether it's in other social media names, etc., or e-commerce platforms. Autos. If you look at the top brands today, you'll see the changing nature of global supply chains and the producers of those brands. So lots of Chinese brands you'll see around you, and obviously you can see that particularly in Africa, maybe your mobile phones, that's a good example. The brand is important because the cost of those products are also important. So I think really in retrospect, what I wanted to really share with you today is that I would love, particularly representing ICBC and Standard Bank, to be more connectivity between China's market and Africa local markets. Not necessarily via other Western markets, but directly with one another. I know already that there's been lots of conversations, particularly on the FX rates perspective, for direct quotes in both local markets. But certainly going into the future, for sure the policymakers in China will be talking very actively to talk about more openness and more connect programs with Africa. Now, back to the 3Ds. So I talked about dual circulation, and that really outlines the key aspects of this year's government work report. I'll go back to that slide one more time to just remind you what's driving China's growth. And if you really want to understand what's driving China's growth, the new growth drivers, please come back to the 3 2s. So this is dual circulation. And this won't happen, the domestic capacity won't happen without careful connectivity with the rest of the world. So it's not just about domestic capacity, it's about the simultaneous interaction with global partners, whether it's through trade, investment, but also through people connection. Second D is dynamic policy making. And this is where the fiscal support this year has been a key emphasis. But that's not to say coming in the next few years, that could very well change. It may be that monetary policy will again become the focus. But dynamism is what's important. And I believe here, similar common ground for high growth nations, in both China and Africa. And then finally, diversification. So diversification from a trade perspective, from an investment perspective especially. When I talk to institutional investors about China, and particularly in Chinese currency denominated assets, I like to talk about it in a similar light to, say, gold investment. It is becoming one of the top performers in terms of diversification from a safe haven perspective. The currency absolutely is seeing devaluation risks and depreciation risks in the face of geopolitical uncertainty, particularly in light of current trade tensions. However, the value of the local currency or Chinese RMB denominated assets provides a relative safe haven because of the relative stability. The currency itself has trading bands. So in effect, from a volatility perspective, it provides a safe haven. So assets denominated in Chinese currency, although will also face similar depreciation or uncertainty, but relative to global markets, it provides the same liquidity, but less volatility. So from a longer-term perspective, and China looks not only 5 years, 10 years, but multiple decades down the line. And that's what differentiates China perhaps from other large, major nations, is that China looks much, much more long-term. So vision is number one. Having a roadmap in terms of how to get there is number two. And then finally, the implementation. So these annual targets have been very important. So final D is the diversification. And of course, what we love to talk more, not just today, but I hope this is a start of a conversation for all of us in terms of exploring how to connect all of our local markets directly. So all of the African local markets are of interest to a lot of institutional investors already, high yielding. China's market, lower yielding. It currently yields below US Treasuries, so why tap into it? The reason being is that there are ways to access that market, highly liquid, big size, but very much a lower cost of funding for those who are able to issue in that market. So I'll leave it there, the 3Ds, and I look forward really to questions, to more conversations and engagement with you. But really, what I would like to see more and more conversations is really between the emerging markets themselves, rather than just via the traditional financial centers. And I believe that direct dialogue has happened and beginning to happen. And I look forward to more issuers to come and explore China's domestic capital markets. So thank you very much for listening, and wish you a great rest of the conference.